So the House and the Senate are back in session this week, and the floor schedules really don't have a lot that's relevant to credit unions, but there is one resolution the House will take up. It's a resolution of disapproval of the Department of Labor's fiduciary rule. We're following this closely. Of course, the Department of Labor proposed their fiduciary rule last year, and they finalized it a couple of weeks ago. And in the final proposal, they address a lot of the concerns that we raised throughout the rulemaking. So the resolution of disapproval isn't that relevant to us, but we're still watching this go through the process. And of course, what the Republicans in Congress are trying to do is they're trying to block the implementation of the rule, and so they're using the Congressional Review Act process to do that. It's something that's pretty interesting to watch. A couple of other things that we're paying attention to this week. Today, Monday, we've got Jerry Reed of Members First Mortgage and Andy Price, who is our Senior Director of Advocacy and Counsel. They will be participating in a roundtable discussion at the Federal Housing Finance Agency on the FHFA's proposed rule on duty to serve for Fannie Mae and Freddie Mac. We commented on this proposal earlier this year, and it's great to get an invitation to meet with other leaders in the mortgage market to discuss the impact this is going to have on lenders. We're also following a hearing in the Senate Finance Committee on business tax reform, and that'll be on Tuesday. And on Wednesday, the Financial Accounting Standards Board is going to meet to continue their deliberations on the current expected credit loss proposal, the CECL proposal. We've been engaged with FASB on the CECL proposal for several years. We've gone up to Norwich, where their headquarters are, to meet with them. We've had them down here in our office. We've got CUNA members on the transition working group for the CECL rule. And once again, FASB is going to meet this week, and they're going to be considering the costs and the benefits of their proposal as they get closer and closer to issuing a final proposal. We expect that to happen in June. So last week, the National Credit Union Administration was the first of what will be several banking regulators to reissue an executive compensation proposal that was first issued in 2011 and is required by the Dodd-Frank Act. FDIC is going to do this, OCC, the SEC, the Federal Housing Finance Administration, and others, they're all required to do this under the Dodd-Frank Act. So what NCUA did and what we were looking for in the proposal is what changes have been made to the proposal since it was first issued in 2011. What the proposal does is it sets up 3 different tiers of rules for large financial institutions. There's a tier between $1 billion and $50 billion. There's another tier between $50 billion and $250 billion, and a third tier for the really large institutions above $250 billion. Now, all credit unions are under $100 billion, so we're really looking to see what were those 2 lower tiers going to do. And the good news is that in the proposal that NCUA reissued, they increased that small tier from $10 billion to $50 billion, really keeping the credit unions between 10 and 50 under a different set of regulations than the really large institutions. They're not looking for to limit base pay or anything like that. What they're really getting into in this proposal is the way that incentive compensations are structured. So if folks are getting paid because of the loan volume or the type of lending that they're doing, they want to make sure that there is some oversight over that. They want to make sure that folks aren't just going out and making a lot of risky loans to increase their compensation, but that there's strong underwriting behind everything they're doing. We're taking a look at this proposal to see how it will impact credit unions. Almost all the credit unions are going to be in that lower tier, at least all the credit unions that are going to be subject to the rule will be in that lower tier. We've met with our examination and supervision committee, and as we get into the comment period process and as we prepare our comment on the proposal, we're going to want to hear from credit unions about how they think this is going to impact their loan officers and other folks that would be subject to the rule. So we're getting into the period of the year where we expect the CFPB is going to start rolling out some additional rulemakings as we get closer to the end of the administration. And so a couple of things to be on the lookout for in the coming weeks. Next week, the CFPB is going to hold a hearing in Albuquerque, New Mexico on arbitration, and we expect that they're going to issue a proposed rule on arbitration at that meeting. This is an issue that they've been studying for a long time. They held a Sabrifa panel. We had a CUNA witness on that panel last year. There's been a lot of back and forth between the industry and the Bureau on how arbitration clauses in financial contracts are utilized. So we expect to see the rule issued next week. It'll be a proposal and we'll comment on it. After that, we expect the CFPB is going to issue a proposal on small dollar payday loans. This is an issue we've been on top of since the Bureau started talking about it many years ago. We've exchanged a lot of information with the Bureau. We've had credit union members come in to Washington and meet with the CFPB around the country over the last several months. Our consumer protection team and our credit union powers team held a summit with the CFPB in the fall to discuss this issue. There has been a lot of work that's gone into the payday proposal to help the CFPB understand that when a consumer is served by a credit union, it is greatly preferable than if they were being served with small dollar loans from unscrupulous providers. So we're going to look at this, we're going to evaluate how it will impact credit unions, we're certainly going to comment on it. This is a really important proposal for the credit union system, and we expect that we'll see it at some point in the month of May.